Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, New York coffee. In the recent past, this market had been subject to two separate head and shoulders patterns. The first was a small December 25 to January 26 head and shoulders top with a neckline extension above the market, currently 288.20. The other was a more recent February to March reverse head and shoulders pattern with a closer to the market, if still above, neckline extension, currently at 281.75. We are still just below both of these patterns, as the market formed a larger late January to mid-June quite long bearish halfway hesitation that triggered lower in mid-May. We already reached the primary target below and came quite close to the secondary harder to reach target X below, down at 230.30, which sits on top of a significant congestion zone between 216.25 to 230.10. However, 2 weeks ago, the congestion below proved to be too strong and prices pushed up through various highs, as well as the 50% Fibonacci line of the June 20 to February 25 move at 262 even, to peak at the green declining short medium moving average last week, which is currently at 273.80. They've dropped back down to the 50% Fibonacci line and seem to have happily stabilized there right now. In the process of heading lower, the market created a quite small, quite acute, bearish Andrews picture from the mid-end May action. However, that was broken on the upside 2 weeks ago and will be retired after this commentary, as will target X below. Now, there is something else I'd once again like to look at here. For this, I'm indebted to Ray Bradbury for asking me about New York coffee 63 weeks ago. And I went at the time to my longer term charts, the monthly charts, where we can see some very interesting insights. You see on my monthly longer term charts, I noticed back then a pattern that had not been immediately obvious to me at the start of 2025. It was a multi-year, 2012 to 2024, very large, reverse head and shoulders bottom with a bright red neckline on my monthly chart, currently at 279.15. The break higher over this neckline reached its primary target on the upside and just about reached its harder to achieve secondary target. Then the market turned lower, and over the course of 2025 and now into 2026 has formed a very, very, very large double top pattern. An Adam and Adam double top based on that bright red neckline. When I last spoke, the market had breached and now broken below this bright red neckline. Hence, I felt obliged 2 weeks ago to lay out some targets below for this really, really, really long term pattern. Thus, the primary target X will be down in the 184.90 zone, amongst the congestion of 2023 and early 2024, and the 2020 to date uptrend, currently at 184.5, with a secondary harder to reach, much harder to reach target X1 down in the 132 even zone, on top of the congestion from late last decade and the start of the 2020s, plus the shallower 2019 to date uptrend, currently at 131.85. Please bear in mind these are long-term, possibly very long-term targets below for this double top pattern. In the meantime, I will be looking out to see what will be the next pattern developing here. London coffee. 54 weeks ago, so a year ago, I said of the bearish pressure on this market, and I quote, "They now have the overhang of the market from roughly 5,300 up to this year's high at 58.49 sitting above." End of quote. This overhang of bearish pressure and ammunition was important as it started back then to press down, magnifying the subsequent breaks lower. The main overhead resistance since then has been the dark blue February 25 to date downtrend, currently at 36.68. It was tested as recently as last week and held pretty well, and is still the main overhead resistance. This downtrend had enough of an impact with me back then that I drew a parallel bright red bear channel based around it, currently at 29.12 to 38.49. We are today sitting well within this bright red bear channel. So if all these moves lower, what now? Well, I said 18 weeks ago, and I quote, "We might take a leaf from New York Coffee's book and look at the last 3 weeks' actions as a possible descending small scallop pattern." End of quote. It seemed the likely case back then. I went so far as 18 weeks ago laying out primary target down in the 34.15 zone with a secondary hardest reach target X1 down in the 30.04 zone. I added at the time, and I quote, "We'll now see over the coming weeks if this vicarious analysis from New York Coffee works here." End of quote. 16 weeks ago we reached target X down at 34.15, and 13 weeks ago powered down through it, gradually heading down towards the lows we saw last in July last year. Even now, despite the move up over the last 2 weeks, I am still somewhat optimistic of reaching the harder secondary target X1. The main obstacle, I think, is the low of April this year, which was caused by that July 25 low at 31.60 in the first place. So watch this one carefully. Now, in addition to all this, back in February we started to create a small, early February to late March, bright pink bear channel, which has morphed into an early February, still bright pink, descending expanding wedge pattern, currently 29.12 to 35.82. In early April, prices breached the pattern on the downside, but was stopped from heading lower by the bright red lower bull channel line, and the breach was repaired. Last week the pattern was breached on the upside, but was stopped by the dark blue downtrend, and the breach was seemingly once again been repaired. So for now the pattern is still good, though as you can obviously tell it's somewhat unreliable. Finally, I drew 19 weeks ago something I've been thinking about for a couple of weeks. October 25 to late January 26, bright green bearish Andrews pitchfork. The market didn't like the steep, acutely bearish angle of attack of this pattern, and as I said 19 weeks ago, and ever since, and I quote, "I have no qualms about morphing this bearish Andrews pitchfork to a shallower bearish shift pitchfork for the same move if the action requires it." End of quote. Well, the action required it, and so we now have a shallower bright green bearish shift pitchfork for the October 25 to late January 26 move, but the market has exited out on the top side of this pattern late 2 weeks ago over the bright green upper time, which is currently at 33.96. The market has used this bright green upper time along with the bright green middle time lower down, which is currently at 29.87. It's used it as an ersatz bear channel since late April until realistically last week, but has now breached it. Prices are now trying to stabilize over it, and I will be watching carefully this stabilization to see if the market would now retire this bearish bright green shift pitchfork. Now, one final point, and it may become a key factor here for June. Thus, if on Tuesday the 30th of June we either close over 33.61 or 30 or under 33.47, then we would be on for a monthly key reversal. Anything in between will have a lesser outside month. Right now we are looking at a monthly key reversal up, and that is something to consider going forward. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.